Morning, everyone. Thank you so much. It's great to see a vast range of people. We got Adelaide, we got Sydney, we got Pottsville, we got Canberra, Brisbane, Wollongong. It's great to see such a diverse crowd. As I said, guys, my name is Mufara. I am the community engagement and customer engagement and community manager here at Owner. And today we're joined for this special webinar by Tawanda, the director of Trendsight. Tawanda is here with us today to discuss the WRP financial reporting and provide all the tips on what the department want to see. So I'm going to stop talking now and I'm going to hand over to Tawanda to take us through.
Awesome. Thanks, Mafaro. Um, Welcome again, everyone. It's good to be back running another webinar with the owner group. And hopefully today's going to be a really insightful one and one that everyone walks away with, feeling a bit better about what reporting for the grant is going to look like for the 2026 financial year. So I'll get right into it. I've got quite a few slides, and I'll make sure that we share the video and then also the slides out after the webinar. So if you do want those, they will be available. As well as that, we're going to have a tool that will provide at the very end. I'm not going to go through it today, only because I think we'll be short on time. But what I will do is make sure that there's clear instructions in the tool, and everyone can use that and ask us any questions if you have them. Great. So who are we? So essentially, Trendsight, we are a childcare specific organization, and we work predominantly on the bookkeeping and payroll side of things to provide really good clarity to centers, and that's both single center operators, but also groups in a whole range of different areas. So it could be long daycare, it could be kinders, it could be OSHAs and so forth. We've been doing this now for quite a few years, and we feel that we're quite comfortable with the space, which is why I'm here today talking to you guys about the worker retention payment. So we're going to cover these 6 items today. So really, it's going to be the focus today is not on the entire reporting that needs to be done, the entire annual reporting, but specifically on the wages and the on-costs. I think that's probably the most complicated section, and one that most people are a little bit anxious about in terms of what numbers to put in there and how to calculate them. So those 3 numbers. The second thing is what counts as wages, what counts as on costs, and then we're going to be talking about how to actually calculate those amounts. What will fall out of it is going to be whether you've got a shortfall or a surplus, and then we'll just summarize that at the very end in terms of what order you do things in. So why is this section important to get right? Firstly, it is actually a statutory declaration, get that word right, which means that there are genuine consequences of getting it wrong. So it's not something that you can just guess at or put little effort into and hope it's right. But we really do need to make sure that we calculate this correctly. It's also really important because it's going to work out whether you've been underfunded or not. And the one thing we want to make sure is that you're receiving the funding that you've been promised. So this is going to be a really good step for you to work out whether you've received enough funds for the worker retention payment you've passed on. Now, the 3 numbers that we're going to be looking at, it's really 2 that we're going to calculate, and the 2 on either end of this image are automatically calculated for you. So you'll see there's 4 fields here, and this is what this entire webinar is about. It's going to be about this very specific section, and it's a little bit annoying that it's just 2 boxes that need to be calculated, but the effort that goes into getting the numbers of those is quite a lot. So these are the 2 areas we're going to look at. Now, the numbers we're going to be reporting firstly are going to be, the worker retention payment funds that have been received. So this is what's come through CCS over the last 12 months. It's pre-filled by the department. So as you go into your form, if I go back, you'll see that it's actually grayed out already. And that's because it's coming directly from the department. The next 2 fields are going to be what you've expended on wages and then what you've expended on costs. So what's unspent meaning, any surplus, or if you've, received more than you expected, is going to pre-fill again for you. This is just a formula. Now, one thing to be mindful of, and you'll see me mention this a few times as we go over this webinar, is you may have received funding. If you receive funding or you got into the program at the very beginning of the financial year, and you received the back pay in the FY26 year, that's going to be actually in relation to wages that were in the 2025 year, but they were paid in the 2026 year. So you'll see I've got a little asterisk at the bottom here, which talks about actually including those wages as well. And this is particularly important if you didn't lodge a declaration last year, but you have received funding for wages that were in the FY25 year. So something to be mindful of. I'm not going to talk a crazy amount about it, but the tool that I provide is going to give you the ability to calculate or to incorporate those wages as well. And just quickly as well, I am going to give an opportunity for questions. So Mufar has turned on Q&A function, so you can go ahead and ask questions in that area. I'll stop in a few different sections throughout the webinar to take those questions, and then as well as that, we'll do questions at the end. So the first bit that I want us to focus on is checking that pre-filled number. So that 90,000 number that you saw in my example. So this is a department's calculation, but it's always important to make sure that that number is correct. So I highly suggest that you have a look at what funds have actually been received through CCS. Log into Proda, or if you're log into Proda and have a look and see what's actually come through the system as CCS. Sorry, as worker retention payment, and make sure it matches what you're receiving on your form. It's going to be really important because that's the start point. If it's wrong, I suggest then calling the CCS help desk to discuss that with them. A thing to keep in mind of as well is that it excludes the historical leave liability. So if you did receive this throughout the year, just make sure that you split out that historical leave liability, because that's not going to be included in your in this reporting. So let's now actually look at how do we do the calculation. Probably the most important bit is to make sure that our definitions are correct. So we're really calculating here what is wages and what is on costs. And it's important because they ask us to split those amounts, and the two together essentially explain out what your total spend on wages and on cost is, and there's going to be no difference in the calculation. So you can see at the bottom here, the unspent amount is what you've received minus your wages minus your on costs. So if you've got a bit of a mixed problem between the two, it doesn't make a difference to what's unspent, but it still does mean that you've incorrectly reported what counts as wages and what counts as on costs. So definitions are really important. So the first part to look at here is, well, what is wages? One thing that's really important to note is that it is worked wages, or worked hours. And that means your ordinary hours, your penalties and overtime, and also your casual loadings, if you are incorporating those in your WRP. What doesn't count is things that are on costs. So you can see me talking about leave paid, superannuation, all those things are on costs, and also anything that's been accrued and not paid. But that'll probably make a bit more sense on the next page. When it comes to on costs, the department's got really 5 things that they talk about when it comes to on costs. They have a little disclaimer in there stating that there may be other items they choose to incorporate later on, but they haven't really changed this list since the beginning. But these 5 items are your super, your employee entitlements, so that means your leave, your annual leave, personal leave, long service leave, your leave loading as well, and then your workers' compensation and payroll tax. So these are the items that count as on costs. One thing that I will flag as well here is what I mentioned in the previous slide. So when we're talking about leave entitlements, we're talking about things that have actually been paid. You can't incorporate your accruals, so leave you haven't paid to your staff members yet. So it's only what has been physically paid to your employees. Now, how do we calculate this? the slide may seem a little bit scary, but this is really about how do we calculate our on costs. Um, so leave is essentially, sorry, we've got our worked hours, so ordinary hours, penalties, overtime, and casual loading. That makes sense. We've got leave, which we just talked about. And then we've got superannuation. So if you're calculating your superannuation on the worker retention payment, you're just calculating, well, what have you worked plus the leave that's been paid. And we exclude overtime and we multiply that by 12%. We can do a similar calculation for payroll tax. We're taking worked hours plus leave taken plus your super, which you calculated here, times by your state's worker retention payment. Sorry, your state's payroll tax rate. And again, a similar calculation for workers' compensation. So there isn't one approach to doing this. And I talk about that here. This is a method to calculate your on costs. It's not the only method. There's no wrong method, or there probably are wrong methods, but there's no strict calculation that's been provided by the department. But this is a way that you can use to calculate. As long as your methodology is defensible, that's all you need to worry about. So how do we get the wages figure right? The key thing to note here is that the wages number is not what is in your payroll necessarily. This does get a little bit messy from the 1st of March when the worker retention payment essentially was reduced by the gender undervaluation. So depending on how you've done your payroll, the way we do it for our clients is we have got prior to 1 March, we essentially had 15% of the award rate going towards a separate line on their pay slips. And we continued that process post 28 Feb, so from 1 March onwards. But now it was no longer 15%. It was now a fixed number as decided by the department, and that number was approximately 10%, but not quite 10%. So we can no longer rely on what's in our payroll to determine how much wages should be passed on. So even though that change happened with gender undervaluation, the important thing to note is that the funding we received stayed exactly the same. And I'm going to show what that looks like on this next slide. So this top line, only relevant if you received funding that relates to this period in 2026. So I'll go from 1 July onwards. So you can see that the worker retention payment was exactly 10% at this point. 1 July 2025, 2.81 is 10% of the award rate. So really, really simple to calculate. That is what is passed on to employees or what you most likely had on your pay slips. It's also what the department was allocating towards, an employee for someone who is, and I'm using a level 3.1, the old level 3.1 or, the new level 3. At 1 December, it became 15%. So that 28.12 times by 15%, we got $4.22. Again, this was what was on the pay slip. However, this was what's on the pay slip, and the money the government gave us was also $4.22. What changed is when gender undervaluation came about. So on 1 March 2026, what we received was $4.22, but you can see that the award rate actually increased. So the award rate went up from 28.12 to 29.52. And that means that what we may have been showing now in our pay slips is no longer what we're receiving. So we're receiving $4.22, but we're not necessarily showing $4.22 on our pay slips or on our payroll platforms. And that's where relying on your payroll information could lead you astray. And here's an example of what that could actually look like. So using that same example, from 1 March onwards, that $4.22, the visible amount on your payslip became $2.82. But the wages remained as $4.22 that counted as worker retention payment. So if we use an example of just 4 months and we reported on our forms, $2.82, which is what's on our payroll platforms, we would actually be underreporting by, $900 for a full-time educator. And if you have 15 of those, that's $13,000. Now, again, that's just an example of how badly we can get this wrong if we rely on what we most likely have on our pay slips, which is $2.82. And this ends up meaning that it may look like you've been appropriately funded or you've got all the surplus available to you, but you actually don't. So really, really important. So for the teachers, there's no change. Teachers are really, really simple. They weren't part of the scope of the gender undervaluation changes that have been made. So for teachers, you'll see that it was 10% from 1 July to 30 November, and then it became 15% from 1 December to 30 June. So this is really, really simple. Teachers, you can essentially rely on whatever's on your payroll reports. Before I go any further, I'll see if we've got any questions. Mafar, I'm not sure if we've got any that have come through so far.
Yeah, there is just one here from Kate. She's asked, is the thought that if we have been overpaid, we will pay back the additional funds, or if we have been underpaid, we will be back paid?
That's a really good question. We actually have, I'm covering that a little bit later on. I will mention it really quickly now, though. You don't have to pay back any surplus funds, but you do need to show that you're using them as per the grant guidelines, and that means towards wages or towards on costs. Those are the only two uses for those funds. So you couldn't reuse those funds for anything else. But yeah. I can see a comment from Eleni saying there's no way you could possibly calculate this for 100 plus staff. You're right. Like it is a lot. The tool that I'm going to provide you guys is going to help with that. But you're right. It is a lot. Particularly, going back to the first 9 months of the year, the first, sorry, 10, 9 months of the year, 8 months of the year, up to 28 Feb. Really, really easy. 10% or 15%. After that, it becomes really, really messy. Particularly given that if you are paying at the award, you don't have the option of really saying, oh, that's okay, I'll just leave their award rate as $28.12 so that I can leave the worker retention payment on their pay slips as $4.22. That's not a good option. And we advise against that for our clients because this is the minimum. This is the legal minimum that you now have to pay from the 1st of March. And if you are showing two separate lines on your pay slip and you're still showing $28.12, you're technically showing an amount that's lower than the legal minimum. So we don't suggest you do that. What we're doing for our clients is we will then track it separately outside. The good thing is we've only got 3 months to worry about in this reporting period. But what I do suggest is to track this going forward on a fortnightly or weekly basis, so however often you pay your staff, so that you don't get to the end of the financial year and now you've got to do this massive piece, figure out, what was everyone's classification, what did they work, and so forth. I can see a question from Sonia about, do we count the amount we received from December 2024 to June 2025 in this reporting period? We did receive the funding before June 2025. No, so if you received funding prior to June 2025, you most likely would have already completed reporting for the 2025 financial year. If you didn't complete reporting for 2025 financial year, I suggest contacting CCS and just discussing what your options are. There is a chance, though, that you got funding that covers December 2024 to 30 June 2025, and that funding maybe was received in July. Now, in that case, that's a different story, and that's how we sort of end up with this period that I'm showing here. That's why I keep referring to this period, because that's for funding that was received in 2026 financial year, but it relates to 2025. In that case, you need to make sure you incorporate, you would have done some back pay in the 2026 financial year. So you've got those wages to incorporate um, as well. Um, Anything else worth answering now?
There is just a question here, sorry, from Larissa. Have I been paying my staff too much? We have been paying 15% WRP for all staff on Children's Services Awards.
If you're paying 15% of the current award rate, then yes, you have been paying your staff too much, most likely. So if I go back to this, and I'll just look at the rates from 1 March. So if you paid 15% of $29.52, then yes. That means that the total amount, so you can see the minimum payable is $32.34. That is the total amount payable. But if you paid 29.52 times 1.15, you're paying $33.95 in total. So it would, based on that question, it sounds like yes, you would be paying more than you have to pay. But again, this is the minimum payable. It's this is messy. Like I appreciate this is very, very messy, and I wouldn't be surprised if there's a lot of people in the same boat. But yeah, great. I might keep going, and then if we've got any other questions, we'll go along. Now, you're going to see these column references in my slides a fair bit, and what they relate to is the grant guidelines. I don't know if anyone here uses any AI tools like Claude or ChatGPT. A really, really handy thing to do is to get the grant guidelines, and I'll show you, I've got a PDF of them here. So log into the portal and download the entire grant guidelines, and there are a good 68 pages. They update them whenever something changes. And these are the latest ones from, I think, July. And pop them in, and it makes it really, really easy to ask questions. Like just say, if you've got a questions about the guidelines and what counts as wages, what counts as on costs, what rate should I be paying this particular employee? It can make it really, really easy to sort of digest all of this information. But I'm going to be referring to these column references. So you can see table 1, column 5. And this is just to tell you which table to look at depending on the period. So if, as an example, we're looking at the 1 July to 30 November 2025 period, for children's services, we're going to look at table 4, which is this one. So table 4. And I'm also going to reference the column that we need. So we're going to look at column 5, which is column 5. And what this is telling us is this is the amount that of worker retention payment that we essentially are going to be receiving. And I say receiving in quotation marks because the department doesn't actually calculate it this way. This is the way that we can calculate what we expect to receive, but it's not the way they calculate the wages. They've made it very difficult. They use some dark arts to to calculate their how much money they actually give you. But this is the closest way we can work it out. So we've got $2.50 if you're a level 1.1. So this is the column to refer to for this period. So you can use this table as a bit of a reference guide, but as well as that, the tool that I'm going to provide does this automatically for you. So if you use that, you won't need to worry too much about that. Now, this is the question we got earlier on, so about surpluses versus shortfalls. So there's no requirement to return any unspent funds. The guidelines as they stand don't require you to return anything. So you won't be in breach of the grant guidelines if you've got a surplus. What you do need to do though is make sure that the money stays restricted. So it doesn't get used for anything else, which isn't the purpose of the grant. And what that essentially means is you can only use any surplus funds for wages and on costs and eligible on costs. That's it. So if you do have a surplus, my suggestion is to make sure you're tracking that surplus. So you've got on your balance sheet showing that you've received surplus funds, but then you can also then choose to use it for things like historical leave liabilities. So if you missed historical leave liabilities for, at 30 June 2025, so if you were approved post 30 June 2025, you wouldn't have gotten the historical leave liabilities. But if you've got some surplus funds, you can allocate those surplus funds towards historical leave liabilities. Um, yeah. Now, the other really important thing that we can do with completing this form is it's going to give you some really good information. If you've completed it well and you've got your workings and you can essentially show that you have a shortfall, you can then request a funding review. And you contact CCS Help Desk. They'll essentially ask you for these four items that I've got at the bottom here. And that means that you're not being left in a position where you have funded this increase and not received enough funds from the government. So don't just assume that I've been underfunded and leave it at that. You do have an avenue to request a funding review. The other thing as well, which is really important, is that they don't ask you to provide workings. So you could, if you wanted to, just go put in whatever numbers you want. But the key thing to note is that this is a statutory declaration, and false statements are a criminal offence in this case, because it is a stat dec. So while you don't need to attach any workings, it is important to have them because the department can come back and say, great, show me your workings. How did you get to the numbers you've got? So the tool that I'm going to provide, go ahead, put all your staff in there, put all your wages in there, but then keep your reports. Keep reports showing what employees have worked. Classifications are really, really important. The structure has changed, but extremely annoyingly, because of the worker retention payment, we still need to refer back to that old classification structure, the old 3.1, 3.2, 3.3. We still need it because that is what determines, what rate staff are paid. If you're if you're a 2.1 or a 2.2, those are different amounts of worker retention payments. So we still need to be aware of that. So make sure you've got a really good record of what your old classification structure is for your staff members and keep that. And then also keep your work paper showing your calculations as well. I haven't talked about agency costs, and I won't spend a crazy amount of time in here on it. But if you do have agency staff that you use, there is also provisions around the worker retention payment for them as well. So I won't go into a crazy amount of detail about that, but just keep that in mind as well. So don't forget your agency staff. Now, to summarize it all, this is what we're going to do. So we are going to reconcile our pre-filled figure to your to Proda or to what you've received. We're then going to pull out our wages and our staff information from our payroll systems, and we're going to use Schedule A, the Schedule A amounts. Whenever I'm talking about Schedule A, I'm referring to this. This is all these tables are in Schedule A of the grant guidelines. We're then going to calculate wages and then on costs. And we are going to sense check that figure as well. And then we're going to go ahead and lodge. Now, the key thing to note is that only a person with management control can sign and lodge this, and it is due on the 9th of October. And that's essentially it. I'll quickly show you the tool that we're going to share. So this is it. There's obviously a lot of words in terms of instructions and what it does, only because this is a little bit complicated. Then there's also a little bit of setup. So this will go through what have you received, what rates are you using, and then from here we're just adding our employees. So we've got we've got all of the classifications built in already. You put in your hire date. Are they casual or not? Are you incorporating casual loading for your worker retention payment? That is an option. It's either yes or no question. So if it's a no, that will be 0. And then you put in your hours based on the periods. So there's really only, there's 3 periods. If you didn't receive any funding relating to this period, there's nothing to enter. So this will be grayed out in the December 1, 2024 to 30 June. So you'd be left with only these 2 periods. So 1 July to 30 November and 1 December to 30 June. You'll note that there isn't 3 periods. There isn't a period from March to June, and that's because the rates didn't change. All that changed was the mix between your base award rate and the worker retention payment amount that was on your payslips. But what you're being funded didn't change. So what we'd be adding here is just your hours. So ordinary hours, annual leave, other leave, overtime, per employee per these two periods. And that would then calculate all your wages per employee. So you can get this information out of any payroll platform. So if you're using Xero, if you're using, Owner, Payroll, or Employment Hero, you can just run the periods 1 July to 30 November, and it'll show you per employee what they've done in these different areas, and you just plug those numbers in. This will take a bit of time, but it is possible. What you'll then be left with is a summary tab. So you'd have completed this on the first tab. It'll show you what you've then spent on wages, what you spent on costs, and then if you've got a shortfall or a surplus, that's the number you'd put in. So you'd end up with these three numbers: wages and on costs, and those are the numbers that go into your reporting. So I'm not going to go into any more detail than that today, only because we will end up spending the little time we have left on it. But this is what we're going to be sharing with you. If you would like that, we've got a QR code here for you to scan, and that will give you access to that template. Like I said, all the rates for all those different periods are already built into the template. So you don't need to worry about trying to find out which rates on which tables is Schedule A to apply for your employees. All you need to know is what is their classification, when do they start, how many hours do they work. And that's essentially it. We've also got a newsletter. We usually send out, so we send out a newsletter every 2 weeks, one which focuses predominantly on payroll, and another one which is specific to the childcare industry. If you are interested in that, please sign up for that newsletter. We'll occasionally also provide other tools that we find useful in our line of business. So if you're interested in getting that kind of information, or not having to wait a few months for us to do a webinar, that's the best place to sort of reach us. But yeah, happy to take any other questions that we have now as well.
Yeah, thanks, Tawanda. There's a few of them in Q&A, so I'll just read them out to you.
Sure.
But also, guys, if you do want to ask your question live, feel free to raise your hand and I can unmute you so that you can ask your question to Tawanda live. So starting off, we've got Sue who says, so if you did receive a HLL payment, can you still use the surplus for a new HLL?
Well, not really, because you've already used. So for historical leave, you've already received a payment for it, and that's sort of already covered it off. What you can use it for, though, is future leave. It doesn't stop it. The grant doesn't stop you from using it, from parking it essentially, and saying, "Great, I've got a surplus right now," and then that surplus could get eaten into in the future. So, as an example, if you close down your service over Christmas or New Year's or something like that, right? There's a good chance that you're going to end up with a slight underfunding at that point in time. So any surplus you have can be allocated there. There's no time limit currently set, but as long as you're able to show that, right now I have a surplus, but later on at a bit of a, shortfall because we're closed over Christmas, and I use that surplus to cover that, then that's a good use of those funds.
Awesome. And another one is there a template for staffing profile for the funding review?
Is there a template for staffing profile? I'm not sure I quite follow that question. Um, Sorry. Maybe we can try that one live if they raise their hand, but I don't quite get that one.
Yeah, Achana. Oh, cool. She's just raised her hand. Give me one moment. All right, you can unmute now.
Yeah. So what I wanted to know was you have to submit some, supporting documents, and one such document for funding review is the staffing profile. So what exactly is that, and how can you support your funding review with the help of that template?
Oh, so you mean the staffing profile of the service? Um,
Yes.
I I don't have that information right now, Achana. I think you're probably best contacting CCS to get a direct answer about that. But I do know what you mean. You're referencing the if I go back a few slides. Um, yeah, here we go. So your staffing profile. So you're referencing this, and that is really in reference to how do you, what does your service look like? Um, what do your, some services choose to have more educators on, or they may choose to have more diploma qualified staff in rooms, which obviously then changes the profile of what your staff look like. The way that they calculate the worker retention payment isn't how we've talked about here. It's all about what they think based on your CCS data is an appropriate level of staffing. So they don't have insight into what your staff looks like, and they've essentially got profiles which they apply to your service, which is why if you look at this number 2, it says check your CCS registration shows right for profit or not for profit status. And that's because there's different profiles on different types of businesses from a staffing perspective, which then impacts how they calculate how much funding is given to you. So they're going to be asking for your staffing profile in that respect. But if you want more information exactly on what that looks like, I think let's get in touch with the CCS help desk.
All right. Thank you.
I
Thank you
can
for your
see one
question.
here. How do we include workers' comp from Lyala? So that I've got a little calculation for you here for that, and it's also in that calculator that I just shared. Where is it? Here we go. So workers' compensation is generally a calculation on, you know, your wages, what you paid to your staff members, and there's a percentage on it. It'll be probably around 3%. So if you look at your latest workers' compensation renewal, there should be a percentage on that. And if you just calculate A plus B times by that rate, you will get your workers' compensation. So the wages we calculate for workers' retention payment will give you your premium that's attributable to workers' comp. No, sorry, to worker retention payment.
There's one here from Bridget. Will we be able to tell by reconciling proto receipts with our profiled amount whether the back payment has been included or not?
That's a good question. I don't know. So I'm assuming you're saying the way that the back payment worked, if I recall, sorry, it's been a little while now, when they started this, if I recall correctly, the way it worked is they gave us two payments at the very beginning. One was historical leave, and the other one was a back payment. Bridget, I don't want to tell you the wrong thing. Let me look at this. Let me look at that question for you, and then I can come back with an answer. But there is a good chance that you do have something mixed in to the back payment, and it's not going to be very clear. But let me look into that one, and I'll come back to you.
There is one here from Maz, and I'm not sure if Maz, maybe if you want to raise your hand and ask this one live, because it looks like it's maybe contextual, but it was, yeah, wasn't it when we fill it in, it's all paid on hours? It's all on paid hours, I mean, sorry.
Yeah, I think maybe Maz raise your hand for that one. Yeah, there we go.
All right, go for it, Maz.
You're not coming through, Maz.
Can you hear me now?
Oh yeah, there
Yes.
we go. Yeah.
Perfect. Sorry. I was just wanting to, sorry, I realized my question didn't make sense. When we fill out the form you shared with us, we just record worked paid hours. So whatever's been worked and annual leave paid as well, and that will calculate our own cost.
Sorry, say that again. So worked, it sounded like you said something about worked hours and leave.
Yeah, so when we fill out the form, it's only on worked hours.
Yes.
So if an educator left today 3 hours early, then those hours will not count on these. Is that
Yeah,
correct?
so what they say is, where do I have that? They've So they talk about paying the eligible on costs for, this is directly from the grant guidelines, including superannuation contribution, employee entitlements, and leave loading. So my interpretation of that is that employee entitlements is annual leave, personal leave, long service leave, and so forth. So what you pay to your employees when they're away from work. And then separately to that, we've got wages. So if I go back to the grant guidelines, and we look at section 5, which is where they talk about it. So they talk about eligible expenditures, wages, and then they talk about paying eligible on costs, including super contribution, employee entitlements, and leave loading. So my interpretation of that is that it'll be a bit unusual for me to include leave loading, which is part of leave, in on costs, but then leave in wages. So my interpretation of that is that employee entitlements is leave. I'm not sure if that answers your question, Maz. Her audio's gone again.
I think it does.
Yeah,
Thank
awesome.
you.
Amazing. No worries. Great. We've got another one from Alex. Is WRP portion adding to leave items same way as for ordinary hour for pay during payroll? I think that's similar to what I just talked about what is essentially hours worked versus leave. So I'll leave that one. We've got one from Imran, which says, I got back paid from December 24 to March 26, and I received my payment in April. Initially, I paid my staff the same amount due out of my own pocket to keep them happy. Is it possible for you to keep the difference now that I've got the back pay? Oh, that's a good one. Is it possible for you to keep the difference now that I've got the back pay? I'm going to send you to CCS help desk with that one, Imran. I'm not sure. My thinking is that so you paid them out of your own pocket before you received the back pay. Well, I mean, technically, you've already paid, like as in you're just being reimbursed for what you've already done. So most businesses would have not paid the we do have a couple of clients that did what you've done, but most businesses or most centers would have not paid the worker retention payment until they got approved. And then once they got approved, they then did a big back pay to cover the period which they're approved from. In your case, you've been paying it throughout that period, so there's nothing further for you to back pay. So it's not necessarily that you're keeping the money in your pocket, it's just that you chose to pay your staff members along the way rather than do one big catch-up pay. So I wouldn't say you're choosing to keep the money, but you've already paid out the worker retention payment, so there's nothing further for you to pay. I'll do a couple more. I am conscious of time. If anyone does have to drop off, feel free to. We are going to send out the recording and everything. So yeah, but I will keep going for a few more minutes. So I've got another one here by Larissa. If you are owed money for WRP, e.g. you paid out more to staff than you received, will they pay us additional funds to cover it, or the business just... No, so this goes back to my point on a funding review. So you've got an opportunity there. So just make sure that you've done your calculations correctly, and your calculations are based on the grant guidelines. And if you're showing that you've paid out more money than you've received, then you go through this process, do a funding review, and then see what CCS says. Another one from Imran. If staff is left prior to you getting the back pay, do you still have to pay them for any worker retention payment surplus? Uh, yes. So it depends. Did they? Uh, that's an interesting question because did they sign an IFA or if you're doing IFAs, we're getting a little technical here, which is not necessarily the scope of the session. But if they had signed an IFA, then yes, you essentially you should be paying them that. But if not, then they weren't ever part of the program. Shay, if an employee changed classification, should we count them twice on the template? Yes, count them twice. So do the first classification, and then when it changes, do a second line. Francesca, do we include allowances and director fee as part of the wages? No. So no. So the worker retention payment is based on the base rate. So if we look at the grant guidelines, you'll see that if I look at any of these schedules, they're just talking about the base rate. So this is the award minimum, and it's a calculation on the award minimum, not including any, educational leaders allowances or director allowances or anything like that. So just the base rate. And then Bridget, if a lump sum end of year payment bonus included in wages? No, wages is the same thing. So wages not included. So same as the answer to Francesca as well. Awesome. I think that's it. Do we have anything else we missed, Mafara?
No, I think that's pretty much one's just come in. May we have a link for the latest grant guideline?
You can access these directly. So if you log into the portal, what's it called? If you let's go to the browser and I'll show you. Work retention payment. So if you log in, you'll be able to so you go to the worker retention payment guidelines. That should give us a link. If you log into Grant Connect, so once you're logged in, so I'll go in, grant opportunity documents, I'll log in, and from here, you'll get all the documents. So you'll see it's a long list, and it looks like there's a lot happening here, but these documents go back to October 2024. So just go to the very bottom, and at the very bottom, you'll get the latest versions. So the latest version's on 14 July 2026. And there's a few bits and pieces, just be mindful what you get. This is the same thing. These are the actual grant guidelines, but one's PDF and one's Word document. And then they also give you what's changed from the previous version. So from version, this version 29th of July. So what you're interested in are these two, the PDF or the Word document. And that is essentially it.
Yeah, that is everything. Thanks so much, Tawanda, for that one. And yeah, like we said, everyone, the recording from this webinar will be sent out to you guys all later today, and will be available for you to review. Before I do let you go, I will just mention we do have the owner group meetup coming up in Brisbane this October, and we'd love to obviously see you there in person. Tawanda will also be there delivering a workshop on pulse checking your worker retention payment. So if you found value from this session today, I'm sure you'll want to be there in person in Brisbane too. There are only a few early bird tickets left, so let me just quickly jump in the chat and make sure I have sent the link, or you can scan the QR code that's there. But yeah, we'd obviously love to see you guys in Brisbane if you can make it. Other than that, everyone, I think that is everything for today. But thank you again, Tawanda. It's been amazing to have you on the webinar today, sharing all your insights.
No worries. Thanks so much, everyone.
Thanks, guys. Have a great day.